Hey everyone, Daniel here and welcome back to another video. The Fed just came out and dropped the absolute hammer on the stock market pertaining to exactly what we're seeing with higher asset prices and the potential for a significant decline in asset prices across the board in the near term. So in this video, I want to summarize exactly what they said, give you guys the implications that this may have on the stock market, and give you guys my opinions on all of that as well. So if you find any value in this video whatsoever, feel free to hit that subscribe button and let's get into it. The first thing we need to talk about here today is the fact that indices across the board have been green over the past couple of days. If you're an index fund investor who invests in the Dow Jones, the S&P 500, potentially even the Nasdaq, you're not seeing a decline in your stock market portfolio. In fact, you're seeing a slight drift up. Absolutely phenomenal. But if you're a stock picker who picks stocks like the Tattooed Chef, Palantir, Etsy, Peloton, the list goes on and on, stocks that are growing quickly and trading at higher multiples, you are currently experiencing a major stock market crash, something that we haven't seen since March. Now, when you look at, this decline that we've seen in stock prices, it's not your fault. It's based on a lot of things, the major thing being a fear of inflation. And what the Fed came out here today and talked about is the potential for us to see a continued decline in asset prices across the board going forwards. Quote, high asset prices in part reflect the continued low level of treasury yields. However, valuation for some assets are elevated relative to historical norms, even when using measures that account for treasury yields. In this setting, asset prices may be vulnerable to significant declines should risk appetite fall. So aside from the fact that we just saw a major stock market decline in a lot of these high growth names, one of the things that has really propelled these companies in a major way over the past few months, potentially past year here, has been low interest rates. And I want to show you guys a chart of exactly what I'm talking about right now. So when we look at the 10-year Treasury note, this is essentially the baseline that we use as a foundation to determine the interest rate at this moment in time. Currently, this sits at right around 1.57%, and although we have recovered, it is significantly lower than the average we have seen over the past decade here in the 2010s, ranging in around that 2% range. So it would not surprise me as an investor to see this potential 10-year Treasury note to increase closer to 2% by the end of the year. And what the Fed is essentially saying here is that, as this 10-year Treasury note increases, we'll see essentially the accessibility of money decline. And when we see a decline in the accessibility of money, there's much less enthusiasm about putting that money into potential high growth names like Peloton, Etsy. Again, I'm not going to name all of them, but a lot of the high multiple, high growth names. So what we see is a correlation with the fact that as interest rates rise, a lot of the high growth names get punished. Adding on to what I just said about interest rates being low, that is one of the things that has propelled a lot of these high growth names over the past year. And when we look at this increasing, risk appetite, just like the Fed said, will most likely decrease as interest rates increase. And when we look at a lot of the high growth, high multiple names, they're generally associated with high risk assets. So, as potentially the 10-year Treasury note increases and as the accessibility of money decreases, we should, according to the Fed, see a significant decline in the demand of assets. And adding on to the fact that we are at significant highs when it comes to valuations across the board. When we look at the forward PEs on the S&P 500's large caps, we're at all-time highs, seeing levels that we haven't seen since the tech bubble. Obviously, this is sustained over the past 6 months roughly. When we look at mid caps, although we aren't as nearly as bad as the large caps, we're still at significant highs, but generally speaking, we're somewhat regular. A little bit frothy, somewhat regular. Looking at small caps, we're right in line with what we saw over the past decade roughly. So what are we seeing in this situation right now? We're seeing assets across the board not sell off to the point where the major indices sell off, but we're seeing a rotation out of these high growth assets and into more safe plays, like potentially big tech names. So that is why you're seeing indices across the board be green, while a lot of these big tech high growth names turning red. We're mainly seeing a rotation not an overall sell-off, and that is the situation that we're seeing now. Now, next thing I want to talk about here is something very interesting pertaining to one of the major reasons we've actually seen this sell-off in the first place. Quote, the potential for material distress at hedge funds to affect broader financial conditions underscores the importance of more granular, higher frequency disclosures. Guys, so what the Fed is saying here is essentially that hedge funds are back at it again and manipulating the market in more ways than just one. Let me take you guys back to a situation. If you were involved in the market back earlier this year in January, we had a major situation with stocks like GameStop, AMC, Express, I could go on and on. A lot of these stocks were shorted to the ground by hedge funds who were essentially causing their stock prices to stay super, super low by shorting over 100% of the float. That shouldn't be possible, but hedge funds were doing that. Now, the thing about hedge funds, they don't necessarily have to report all of these different things. So what the Fed has said essentially is that, we need more transparency when it comes to hedge funds. And when we look at this most recent market decline that we've seen, it has been very, very profitable and very, very beneficial for a lot of these hedge funds to buy puts, to leverage, to short. So what we've been seeing is a continued cycle of a lot of these hedge funds continuing to buy shorts, and as those shorts make money, they buy even more, and they continue to make money more and more and more. They're getting more and more leveraged, and eventually we know that this rotation will change. And what the Fed here is saying is that, hey, hedge funds, we need more transparency with you guys because we have no idea what you're doing behind these closed doors. You might be shorting these stocks to the ground, which is what you're doing, and that's one of the main reasons as to why we're seeing this major decline in the stock market at this moment in time. So if I could give you any advice as an investor, the market experiences times of volatility on a regular basis. Sometimes that's based on pure fundamentals. Sometimes it's based on FUD, fear, uncertainty, and doubt. Currently, we have a situation where nothing fundamentally really backs a lot of these giant declines that we've seen in a lot of these stocks. Potentially some were overvalued. Potentially some are now reacting to the fear of inflation, which, as we know, isn't that big of a fear when it really comes down to doing the math. So looking at these different stocks, the best advice I could give you, if you own high quality companies, you have nothing to worry about. If you own more speculative plays, obviously the situation is different, but I want you to sit down, take a look at the companies that you own, and say, all right, if the interest rates rise, is my company going bankrupt? For 99.9% of companies out there, the answer is no. Ask yourself, if hedge funds short my stock, are they going to go bankrupt? Probably not. If you own companies that will continue growing over the coming years, no matter what happens, this is all just fear, uncertainty, and doubt trying to get into your emotions. So given what's happening currently, when investors are fearful, that is when you should be greedy. When investors are greedy, that is when you should be fearful. One of the best Warren Buffett quotes out there. The best time to buy stocks and add to your positions is in times like this, when stocks are selling off for no reason. When a stock like Etsy, which is an absolutely phenomenal company, I haven't made a video on them, but I absolutely love them, falls 15% after smashing earnings and raising guidance for Q2, that is a reason to buy a stock, not sell a stock. And we're in a time right now in a very fragile market where hedge funds are shorting stocks to the ground, where a lot of these stocks are falling on very good news. We're just in a very negative environment. So if I could give you any advice, if you don't have money on the sidelines and you hold great companies, take a blindfold, put the blindfold on, let's just hibernate for a couple of months and come back in the summer when hopefully things are recovered. Anyways, guys, thank you so much for watching this video. I really appreciate you being here. If you found any value whatsoever, feel free to share this video with a fellow investor. See you guys next time.